Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Short-term FX is, you see a lot of players in this market that don't do trend trading, that are very news-driven. And again, the shorter term, the time frame you're operating in, the more the news-driven type of strategy can tend to work for you. But you have to be very, very fast, and usually on a desk, a major desk somewhere, to get ahead of the crowd on news-driven stuff, because you're going to get that, maybe seconds or more before it gets maybe onto a Reuters screen or something like that. So we see a lot of that, and that tends to be done, as I said, very short-term, intraday stuff, usually by dealers that are making very, very small pips here and there, scalping positions, so to speak. Very, very hard for us to do, again, because we're not, we're not on a major desk. And if you have a real job, it's almost impossible to do. So, people often are sucked into the currency markets on this idea that they can trade this intraday spot Forex. You see the advertisements all the time. But what they don't tell you is you're trading against the best traders in the world when you're trying to trade intraday on this news-driven type of stuff. I would say step back and really look at this FX options product precisely because it takes you out of this competition with the guys on the desk that have a lead on you in many, many ways. With the longer-term FX options, you can step back and use some of those fundamentals if you're fundamentally driven, and you can trade those longer-term trends and sit out some of those whipsaws in those tighter time frames. As I said, the tighter the time frame, the more whipsaws you're going to get because of these news-driven events throughout the day. Ultimately, currency prices are driven by supply and demand in every time frame, and that's why trend following works. Price tells you everything that's going on in there. You shake everything out of the market, take all the news out of the market, all your reasons out of the market, because currencies are supply and demand driven, and they're not, you can't manipulate the currency markets over a decent period of time, maybe near term, maybe intraday. Governments can do things and people can create some rumors to do things. But over time, the market's so big that ultimately supply and demand is the driver, and that always shows up in price. All those actions and all those decisions show up in price. Therefore, that's why this free supply and demand market, unregulated basically from governments, the inability from governments to set prices, really allows for a cleaner trend type of trading in this market than you see in other markets. Markets tend to overshoot in the currency markets. What I mean by overshoot is they tend to overshoot their fundamentals on the high side. They tend to overshoot their fundamentals on the low side, meaning, let's take the dollar, for example. The dollar's going down, down, down. We don't know where this trend's going to end, but we know when the dollar trend finally ends on a relative basis. Already now it's extremely, I shouldn't say extremely, but it's undervalued based on its fundamentals in the market at the moment, even though the fundamentals are ugly. If you look at just some background fundamental analysis, the dollar is overdone. It can be overdone a lot further than it is now, but this is what you get in currency markets because of the fact that people are always struggling with what's the driver here. What's the news event that's important? What's the background stuff that's really important here? Which of these rationales make sense? We saw one of those false rationales in the market this week in the currencies. Oh, there was some secret meeting by the Saudis and the Chinese and the Russians. They were in the background, hush, hush, saying we're going to flip a switch and the dollar is going to lose its world reserve currency status. That's the type of really silly rationales you get in markets that are starting to self-feed. But if people act on that news and people believe that news makes sense, they're going to put money into the trend. So it doesn't matter. Perception becomes reality. And because of that inability sometimes to shake out a rationale that makes sense and a rationale that doesn't make sense that you can more easily do in the equity markets or the bond markets, You tend to get that more in the currency markets, and you get these longer trends, and that makes it good for trend traders. It means you can ride a trend longer both ways. So that self-feeding aspect is a very good thing for trend traders in the market, and that's why it tends to be more successful, I think, in the currency market than it does even in the stock and bond market. Just to recap a bit, let me get a smaller pen here. That's a little thick. Massive pool of global capital just sloshing around out there, and it's moving into what is the best trend, actually. You're seeing that on, as I said, on different time frames. Intraday, you're going to be more news driven, but even intraday, you're going to get a lot of traders that use very, very short-term trends. They're using indicators that we wouldn't say are trend indicators, but to them they are. They may be using what's called pivot points in various time frames, and these pivot envelopes, and these small moves within 5, 10, 20-minute time frames where we would go, wow, that's just so short. But if you're staring at your screen all day and that's the way you make your money in every 1, 2, 3-minute time frame, 20, 30, 40 minutes to them is a trend. So there is trend trading, although it doesn't appear that way even sometimes in these very, very tight time frames. We know interest rate differentials and economic growth, really that's the fundamental stuff, the stuff that really does move currencies from a fundamental standpoint. Again, price is the final arbiter of all this, but interest rate differentials and economic growth, those are part of the nuances I think you can kind of overlay onto the trend in the background to help validate, and I'll show you that in just a second, some of these moves. As I said, we get self-reinforcing trends, and we get a boom-bust sequence. We get more of a boom-bust sequence in the currency market, which is, again, makes it, as I said, very good for trend trading than we get in other markets, precisely because there's a lot of false rationales in the market, and there's a lot of different rationales in the market. And the reality is, if prices move in a direction I like, I'm jumping into this whether I understand it or not. So this is why you're constantly getting more and more people moving into this market using more of this trend trading approach. Technical analysis, that's basically what we're doing here in terms of trend trading. Very simple technical analysis I suggest you stick to, and I think it can be very easy. The key, as I said, is defining your time frames. Yield differential and growth comparisons you can look at and overlay, and the environment analysis makes sense to overlay to really give your trends, again, some more nuance and some more validity, and I'll explain that in just a second. So, price is the primary driver. That's why we look at charts, fundamentals and expectations versus price. One of the things you can also do, and as you're just watching the news during the day, you don't have to be watching every day, but as you get at the end of the day and you're reading the paper and you're just looking at the price action, one of the big things that I don't think people really take into account enough is really this simple idea of, is the price action, how is the price action relative to the news? Now, this says a lot, meaning if you have good news and bad price action, and you're near a certain indicator, or at least near a key trend point that you see, that's a powerful indicator to you that says, hey, pay attention here. Maybe something's starting to overshoot, and all of a sudden the price comes out very good, which suggests the trend should continue, but you're near one of your indicators, or at least your triggers, if the price starts to back up, and all of a sudden very good news comes out and a currency acts very, very badly and starts to pull back towards a level where you want to get in. That's usually a very high probability trade when you start to see that, because a powerful trend that stays in place, you're usually going to get, it's going to continue in place on good news, and it's going to continue in place on bad news. So when you see bad price action relative to the news, don't ever underestimate that. It's a powerful qualitative indicator, and when you line that up with your basic model, it can really put you on alert to set up for a good trade to get in there early.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.